Have you ever noticed that the wealthy seem to have cracked a code the rest of us are missing? It's as if they're living in a parallel universe where debt isn't a burden, but a tool to build more wealth. In reality, they are leveraging a set of strategies that most people overlook. Today, we're uncovering 10 ways the rich use debt to get richer. Strategies that might just transform how you think about borrowing and help you make smarter financial decisions. Whether you're just getting started with finances or already building a portfolio, understanding these strategies can be a game changer. And if you're new here, don't forget to subscribe and hit that notification bell for more life-changing financial insights. Let's dive into these game-changing strategies. Let's get started with the first topic on how the rich leverage debt to build businesses. You see, the wealthy don't see debt as something to avoid. Instead, they view it as a resource to build something bigger, like a successful business. They don't fear debt because they know how to use it wisely. Instead of using their own cash, which could be tied up in investments, they borrow to cover startup costs, leaving their capital intact for other opportunities. John D. Rockefeller, for example, borrowed money in the 19th century to start Standard Oil, turning a small loan into a multi-billion-dollar legacy. Let's look at why this works. Borrowing money at a low interest rate can fuel growth quickly. Suppose a wealthy entrepreneur wants to start a tech company, needing $1 million to get it off the ground. Rather than using their cash, they take a loan at a 5% interest rate. They're confident that with the right investments, the business can generate returns of 15% or more. Here, the debt costs them 5% annually, but the returns could be 3 times that amount, yielding a net gain. The wealthy focus on cash flow over cash ownership. To them, it's more important that money flows into the business and multiplies rather than using cash reserves. With smart planning, they structure these debts so the business itself can cover loan payments, while they benefit from increasing ownership stakes. By using debt this way, they don't just build businesses, they build empires. Moving forward, let's dive into how to use debt to scale and acquire assets. Scaling up a business can require substantial capital, and the rich know that using debt to expand is often smarter than funding everything with cash. The rich use debt to get richer by taking out loans to purchase assets or acquire smaller competitors, multiplying their income streams and market control. Think of real estate moguls. They don't buy one building and stop. They use borrowed money to acquire multiple properties, each adding to their cash flow. Let's take the example of a real estate investor, Sarah. She already owns a successful rental property but wants to buy 2 more. Instead of depleting her savings, she takes a loan for each new property. Her strategy is simple. Each property generates rental income that covers the mortgage and still leaves her with monthly cash flow. By doing this repeatedly, she scales her business without putting her own money at risk. For the wealthy, debt is a tool to gain control of high-value assets without tying up their own funds. Each borrowed dollar is strategically aimed at assets that bring cash flow and appreciate over time. By leveraging debt, they multiply their assets, positioning themselves for long-term financial security. It's like adding engines to a train. The more engines, the faster they reach their goals, all without sacrificing liquidity. Let's tackle the next topic, the power of low-interest debt. One secret the wealthy know well is how to take advantage of low-interest debt. Rather than paying in cash, they secure loans at low interest, allowing them to invest their own cash elsewhere. Take the example of Mark Zuckerberg. In 2012, he bought a home and secured a mortgage with a 1.05% interest rate, despite being worth billions. Why? Because Zuckerberg knew he could earn more by investing his capital than the mortgage would cost him. Let's say a wealthy investor has $500,000 in cash. Instead of using it to buy a property outright, they put down 20% and take out a mortgage at a 3% interest rate. They then invest the remaining $400,000 in stocks yielding 8% returns. By keeping their capital invested, they make 5% more than the interest rate on the loan, resulting in a substantial gain. This tactic isn't about avoiding payments, it's about earning more than what the debt costs. Low-interest debt can be seen as free or even profitable money. The rich understand this and actively seek out favorable loan terms, knowing they can keep their cash working at a higher rate of return. I hope you found this video helpful. If you're eager for more content like this, drop a comment below saying, "I'll be the first wealthy person in my family." That way, I'll know exactly what types of videos you enjoy most. Get ready, because I am about to explain how to use debt as a tool for tax efficiency. Taxes can be one of the biggest expenses in wealth accumulation, So the wealthy use debt to reduce their tax burdens. This is a major way the rich use debt to get richer. They borrow money, which isn't considered taxable income, allowing them to live off loans rather than selling assets. Instead of cashing out stocks or other investments, they take out loans against them, letting them grow tax-free while they enjoy the benefits. Let's look at an example. Imagine a wealthy individual who holds a significant stock portfolio. Rather than selling shares and paying capital gains taxes, they borrow against the portfolio at a low interest rate. This way, they have immediate access to cash without triggering a taxable event. If the portfolio's value increases over time, they not only retain ownership, but also benefit from tax-free growth. Wealthy individuals know that the longer they hold assets, the more they benefit from compounded growth. By using debt as a tax-efficient strategy, they optimize every dollar they earn and avoid losing wealth to high tax rates. It's a clever move that keeps their net worth growing while staying on the right side of tax laws. Let's explore the importance and methods of separating business and personal debt as we move forward. The rich also make a clear distinction between business and personal debt to minimize risk. When Elon Musk bought Twitter, he structured the acquisition so that Twitter's assets backed the loans, not his personal assets. This means if Twitter doesn't perform, his personal wealth isn't at risk. Separating personal and business debt is like building a financial firewall. Let's say a wealthy entrepreneur wants to open a new branch of their business and needs $1 million in capital. Instead of risking personal funds, they create a separate entity for the new branch, taking out a loan that's tied to that entity. This way, if the new branch doesn't succeed, their personal finances stay secure. For the rich, using this approach creates a safety net. They avoid risking personal assets while taking business risks that can potentially bring high returns. This tactic preserves their wealth by protecting them from liability and ensuring that business setbacks don't affect their personal finances. It's a calculated approach that allows them to innovate without sacrificing security. Alright, let's tackle the next topic. Borrowing to invest in cash-flowing assets. This is one of the core ways the rich use debt to get richer. Instead of using savings to buy assets that generate passive income, they use borrowed money, allowing their cash to remain available for other investments. Assets like rental properties, dividend stocks, or franchises can generate income to cover the debt and leave extra cash flow. Here's how it works in real life. Consider Sam, an entrepreneur who saved a comfortable amount over the years. Instead of letting his savings sit, Sam decides to buy an apartment complex that will produce rental income. Instead of using his own money to buy the property outright, he takes out a loan with a low interest rate, confident that rental income will cover the mortgage payments. Now Sam's mortgage costs $2,500 a month, while the property brings in $5,000 monthly in rent, leaving him with a profit of $2,500 after expenses. Think of it as planting a money tree. He borrowed money to buy the tree, but the fruit it bears each month covers his debt payment and still leaves a surplus. Over time, the property appreciates, allowing him to refinance or increase rent, which boosts his cash flow. The key here is that Sam's debt is covered by the property's income, allowing him to use his initial savings for future investments. This strategy lets the wealthy accumulate assets while using cash flow to maintain debt payments. By keeping cash flow positive, they turn debt into a tool that doesn't drain resources but builds wealth. Prepare yourself, as we're about to delve into leveraging debt as a hedge against inflation. Inflation is one of the most significant but invisible threats to wealth, reducing the purchasing power of money year by year. However, the wealthy understand that debt can act as a hedge against inflation. They know that by locking in low-interest, long-term debt, they're effectively borrowing in today's more valuable dollars and repaying with cheaper dollars in the future. It's almost like getting a built-in discount over time, which can be incredibly powerful. Consider a wealthy investor who takes out a 30-year loan at a fixed interest rate of 3% for $1 million. At that rate, they're paying a set amount each month for decades, regardless of how much inflation rises. As inflation gradually pushes up the cost of goods, services, and even rental income, the real burden of that loan effectively decreases. The loan amount stays the same, but the revenue or appreciation of assets often rises with inflation. This approach makes the fixed interest rate an advantage rather than a burden, as inflation erodes the value of the debt over time. Moreover, the rich use this strategy in real estate, where rental income typically rises with inflation. As rental income increases, their monthly debt payment remains the same, creating a larger margin of profit. In this way, inflation doesn't hinder their wealth-building strategy, it actually enhances it. They see inflation as a wave that lifts the value of their assets while their debt remains anchored. For the rich, debt isn't just borrowed money, it's a calculated tool for staying ahead, even when the economy fluctuates. Let's explore the importance of using debt to control high-value assets. The wealthy understand that controlling high-value assets can be just as powerful as owning them outright, and debt makes this control possible without draining cash reserves. This approach is another major way the rich use debt to get richer. Rather than putting up millions to buy a high-value property or business outright, they make a down payment and borrow the rest, gaining control of the asset while keeping their liquidity intact for other investments. Let's say a wealthy investor wants to acquire a $10 million commercial building. Instead of paying the full amount in cash, they put down 20%, or $2 million, and finance the remaining $8 million through a loan. Now they control a valuable asset that generates income and appreciates over time. With debt covering the majority of the investment, they've kept $8 million available for other ventures, giving them both control over the building and freedom to invest in new opportunities. This approach allows them to multiply income streams while minimizing risk. By leveraging debt, they gain access to high-return assets, all while preserving cash that can go toward other wealth-building activities. The building not only provides rental income, but also appreciates, creating a dual benefit of cash flow and long-term value. For the wealthy, this strategy creates a self-reinforcing cycle, where each asset acquired with debt serves as a stepping stone toward the next high-value opportunity. Rather than locking all their wealth in a single investment, they use debt to control and grow multiple assets simultaneously, amplifying both their earning potential and financial flexibility. Coming up next, we'll delve into how strategic borrowing can help you avoid personal liabilities. One of the lesser-known ways the wealthy protect themselves when using debt is by strategically structuring loans to avoid personal liability. By ensuring that debt is asset-backed, they limit risk to the specific investment rather than their entire portfolio. This approach, known as non-recourse lending, means if the asset fails to generate the expected return, lenders can only claim the asset itself, not the borrower's personal wealth. This is a critical way the rich use debt to get richer while safeguarding their financial safety. For instance, when Elon Musk acquired Twitter, he structured the acquisition so that the loans were backed by Twitter's assets, not by his personal wealth or other businesses. This way, his personal holdings in companies like Tesla and SpaceX remain secure, regardless of Twitter's performance. If the investment performs poorly, the liability is restricted to Twitter itself. This type of firewall between business ventures and personal finances allows the wealthy to take calculated risks without putting their personal fortunes on the line. Imagine a real estate developer who sets up each property as a separate legal entity, such as an LLC. Each property secures its own loan, meaning that if one property underperforms, it doesn't jeopardize their entire real estate portfolio. By isolating risk, the wealthy ensure that one setback won't unravel their entire financial empire. They can venture into multiple high-stakes projects with confidence, knowing that any potential losses are contained within specific investments. This disciplined and cautious approach allows them to explore aggressive growth opportunities without compromising their personal wealth, reinforcing a cycle of protected expansion. The final strategy is reinvesting borrowed funds to secure returns that exceed the cost of debt. This practice is often referred to as positive leverage. When the wealthy borrow at low rates and invest in high-return ventures, they effectively profit from the difference, growing their wealth without tying up their own capital. It's a strategy that requires careful calculation, disciplined investing, and a thorough understanding of financial markets. Imagine a high-net-worth individual borrows $1 million at an interest rate of 4% per year. Instead of spending that money, they invest it in a diversified portfolio, yielding an average of 8% annually. They're not just breaking even. They're profiting from the borrowed funds by earning an extra 4% each year. In this case, the debt becomes a financial advantage, allowing them to accumulate wealth more rapidly than if they had only used their own money. This method is particularly effective in real estate, where investors borrow to buy properties that generate rental income. As long as the rental income and property appreciation outpace the interest payments, the investment generates positive returns. In essence, they're borrowing to grow, using someone else's money to build a profitable portfolio. But it's not about reckless borrowing, it's calculated, and every loan is tied to a well-researched asset that's expected to produce returns above the debt's cost. For the wealthy, this approach creates a perpetual cycle of growth where borrowed money continuously fuels new investments, expanding their wealth without exhausting their personal resources. And there you have it, 10 ways the rich use debt to get richer. These aren't just financial tricks or shortcuts. They're well-planned strategies grounded in a thorough understanding of how debt, when used wisely, can create tremendous value. The wealthy understand that debt isn't inherently bad or something to be feared. Instead, they see it as a powerful resource, a tool that can open doors to opportunities that might otherwise be out of reach. By strategically using debt to build businesses, expand their portfolios, and hedge against inflation, the rich grow their wealth without depleting their own reserves. They know the importance of separating business from personal assets to protect their wealth, as well as the potential tax advantages that come from borrowing rather than selling off valuable assets. Each of these methods contributes to a cycle of growth and security that continues to build on itself. These strategies reflect a mindset shift, viewing debt as an asset rather than a liability. For the average person, debt often feels like a weight, but to the wealthy, it's a stepping stone toward more freedom, greater financial stability, and ultimately, a life with more options and flexibility. If this video gave you new insights on how debt can be used as a tool for building wealth, I highly recommend checking out my next video, which complements this one perfectly. Don't forget to like, share, and subscribe to our channel. And let us know in the comments if there's a specific topic or strategy you'd like us to dive deeper into. With the right knowledge, anyone can take control of their financial future. Until next time, stay savvy, keep learning, and go out there and build the financial future you deserve.